When you will ask an expert about how to build a successful stock portfolio, they will say something that can sound too simple, but I think it will take beginners a few years' time to understand the depth of it. Managing a portfolio is less about picking stocks and more about managing our own decisions over many years. Let me try to explain what it means by managing our own decisions from the context of stock investing and portfolio building. When I started investing, it was around 2008 2009. I thought my main job is to find the next 10 bagger. I used to read market news every day, check the prices of my stocks multiple times, and I used to feel productive just because I was tracking the market. But after some time, when I saw that on my portfolio level, nothing is improving, I realized that I'm confusing activity with progress. Just watching stock prices move up and down doesn't build wealth, nor buying any stock that comes my way will build the wealth either. This simple sentence might be sounding very logical today, but in those days it took me many months to realize it. What I was focusing on was a non useful activity. I should have focused on owning good businesses at a right price. This is a useful activity. So, the first thing I did from this realization was to slow down and to actually understand what I was buying. Instead of asking, will this stock go up next week? I started asking, what does this company actually do? How does it make money? Will people still need its products or services, say 10 years from now? For example, it's very different to buy a bank because everyone on TV is talking about banking stocks versus buying it because you understand how the bank earns through loans, through deposits, and through its interest margins. Another important realization was that a portfolio should not depend on just one or two ideas. We hear stories of people making huge gains from a single stock, but we rarely hear the stories of losses caused by such a concentrated portfolio. If I have to make an estimate, I will say 90 out of 100 people who have such a concentrated portfolio will end up making huge losses over time. So, as soon as I realized it with my own experience, I began spreading my investments across different companies and asset types. I started with a few large, stable businesses and some growing companies, and a few safe instruments like fixed deposit, hybrid funds, etc. I was not doing this because it sounded sophisticated, but it was an intentional decision to keep my portfolio money spread into different types of investments. Today, after 15 years of building my own stock portfolio, I can say that this type of diversified portfolio helps me to sleep better at night. Even if one sector struggles, my entire portfolio doesn't collapse with it. The portfolio behavior gives me a much longer holding time. If I used to hold stocks in my concentrated portfolio for say 2 years, I was able to hold stocks of my diversified portfolio for 5 to 6 years easily. It helps me not to panic when the price is falling. I also had to become honest about why I was investing in the first place. Was I investing for short term excitement or for long term financial stability? To answer this question, I had to ask another question. What type of investing suits my personality? The goal that resonated strongly with me was financial independence. Once I connected investing with a real life goal like financial independence, my investing behavior changed automatically. I stopped reacting to every market fall as if it is an emergency. Market volatility used to make me uncomfortable. Even a 5% drop in portfolio felt like something was wrong. Over time, I understood that price movement is normal. The intrinsic value of businesses doesn't change just because its stock price has fallen by 5%. Think about a local grocery shop that you know well. Will its value change just because fewer customers came on one fine Tuesday? Likewise, in the stock market, the price of stocks change every second. Sometimes these dips can also be in the tune of minus 15 to minus 20%. Such huge price movements can make even a small stock volatility look extremely dramatic. But we must remind ourselves that volatility is a core characteristic of a stock. Moreover, stock price changes does not change the fundamentals of the company. This is very important. One habit that helped me a lot was reviewing my portfolio at fixed intervals instead of constantly checking it every day. Now, I mostly review my investment periodically, asking simple questions. Do I still understand why I bought this company? Is the business still performing as expected? Has anything fundamentally changed in this company? If the answer is yes, I usually do nothing. At least I do not sell my holding. Deciding to do nothing, I have learned, is often a very powerful decision in stock investing. Another thing that I have realized after more than a decade of being in the stock market that I must continually improve my own ability as an investor. Early on, I believed returns came from buying quality stocks. Later, I realized that even better returns can come from good judgment. How to make good judgments? Reading about businesses, learning how to read companies' annual reports, understanding from your own mistakes, and learning how markets behave during bull and bear phases. These deep understandings can make a much bigger difference than any single stock selection. In stock investing, emotional control is especially important. When market rise quickly, it's tempting to believe we are smarter than we really are. Similarly, when markets fall, it's easy to panic. I have experienced both. Over time, I have learned that consistency matters more than intelligence in investing. A calm investor with only an average knowledge often does better than a brilliant investor who reacts impulsively. Patience is also a part of emotional control. It plays a huge role in building a multi-bagger stock portfolio. But when I say patience, I am talking about a time period that is half a decade and not few months. Many new investors expect results in months, but businesses do not grow in months. They grow like waves, like a sine curve. And the time between two peaks in a sine curve can be 3 to 5 years long. So in stock investing, patience means to be mentally and emotionally strong to stay invested between two peaks of a sine curve. You will always find great investors talk about the power of compounding. Compounding may feel slow in the beginning and then becomes very visual later. It's similar to planting a tree. We cannot dig it up every week to check if the seed is growing underneath or not. But one thing is sure. If you leave the tree to grow, one day you will surely get your fruits. The thing we must remember about compounding is that in the later years, the invested money starts to grow at an astronomical speed. Maybe for the first 5 years, the change will look negligible. But from the 10th year onwards, the effect of compounding really becomes visible. So invest in good stocks and stay put. Do not sell them just because others are selling. So if I have to summarize my approach today, I will say this. I try to buy businesses that I can understand. I also spread my risk across different asset types. And I also connect investing with my long-term life goals. I also review my decisions calmly instead of being reactive. Moreover, I also try to increase my knowledge of investing as the time goes by. There is no perfect portfolio and no perfect investor. Even Warren Buffett make mistakes. If I talk about myself, managing a portfolio today feels less like chasing the market and more like running a long-term personal project. This type of behavior, which is practiced with discipline, clarity, and patience, is well rewarded by the market. And honestly, that shift in mindset made investing much simpler than I once thought it was.